Let's see, we got Shakeout is going to be the last topic on here that we haven't touched upon. Again, we already touched on the percentages. And I will give you a recent example of a trade that I'm currently in that actually shook me out prior. So this OPCH, again, we're talking about a very simple bull flag pattern. And we can see this earnings bull flag that formed. We're talking about earnings flag. OPCH had earnings. The stock gapped up on earnings, which is a good sign. And then it starts to flag out. Typically, if you've seen any of our parody video about earnings, you want to typically wait 4 to 6 weeks for a name to flag out during earnings before you should expect a breakout. This stock gapped up end of February. It's now the end of March, or end of April. That time has elapsed where it's been flagging long enough after earnings that a potential breakout is probably in the cards. Now, I was, again, too early to this trade. At that time, 31 quarter was the out. But again, we don't want to put stops above the whole number. So I was willing to give it a little bit more room versus 31 with a 30.89 stop. Again, we never put stops on the whole number. Now, for nearly 2 weeks, the stock broke above 32 and continued to flag in between, bull flag between 32 and 31. It was in this consolidation period. All normal action with the goal of adding through 32 when it was ready to break. The problem, though, was it broke down under 31 and shook me out. It traded below that area of where I was willing to risk to name the proper risk I was willing to give this name. It shook me out and immediately went back. So right off the open, my stop for 2 weeks had been under $31. And for 2 weeks, it had never been tested. This day, it shook me out, shook out a few other buyers, a few other sellers, and immediately went back. How this name closed that day showed me this was a shakeout. If it was not a shakeout and the stock was breaking down, it would have been more like an example like this over here, where it came into support and broke and closed lower dramatically. This is why you want to have those stops in place, because if this was to occur, I would be very happy with selling at 32 and taking that loss, then sit with this thing down to 28. But there are times, like in this trade, that it hit 31, which was where my stop was at, and it did not want to go lower. But these are things that it's hard to anticipate in the moment. You have to respect that game plan. And my respect with this trade was to give it $1 risk. It headed lower. I took my loss and moved on. When I saw this close and the following gap up, that was the confirmation that this was the shakeout. This was shaking at the weak hands. I'm the weak hand in this example because I was only willing to give it $1 worth of risk. And the reason for that, again, it's a $30 name. If I give this down to 30, which would have kept me in the trade, that's $2 risk. This stock needs to go to nearly 42 for me to achieve 5-to-1 risk reward. And realistically, this name is probably not going to get there within the time I'm going to be in this swing. The stock needs to retest and break this prior high and do a lot more before it's going to really get up there. And that's where I want to keep the risk tighter, risking $1, where this retesting this high and pushing to 37 would give me 5-to-1. That seemed more realistic in the trade than hoping and praying it's going to, trade 10 points higher. But this is I had to be consistent. I did buy this thing back, and I will still trade it out accordingly. So this is a good example of shakeouts. This will happen in trading, especially for a swing trader. Shakeouts are part of the game, but respecting your stop and having them in place, there will be times you get shaken out and it'll be frustrating. But there will also be times like this arrow over here that when the stock is really rolling over and is bound to trade lower, you'll be very thankful that you took whatever that percentage loss was before having to sit through further pain. So these are the major points, again, of this book that we want to hammer in. We want to hammer in focusing on the game plan prior to putting the trade on. It is great to write it down on pen and paper. I store my trades on every day on pen and paper: entry, stop, and target. Once you're in the position, enter your stop. After a few days of trading have occurred, if it's trading in your favor and you have a new pivot low, you can raise that stop. You do want to be aiming for 5-to-1 risk reward. And you want to be keeping that parameter of risk where you can risk 1 to 5% in a given idea, where making 5 to 25% is a realistic outcome in the name.